Do you have your surfboards, your wetsuits ready for the coming wave of foreclosures? Hey, what's up everyone? Andy Howell here, local real estate agent and investor here in Columbus, Ohio. In today's video, we're talking about potentially this coming wave of foreclosures. Before we get into that though, please reach down, hit that subscribe button. We've been making videos all about Columbus, what it's like to live here, the cool things that are happening right here in Columbus. So your subscription lets us know we're on the right track. You're valuing the content we are putting out, so thank you. So I get this concern all the time from my buyers and sellers. I totally get it. Like, what is happening with the real estate market? It's been on an absolute tear, especially these last 2 years, but really we've been in a bull run for like 10 years. And at some point that's gonna have to come to an end. When COVID happened, at the onset, I initially thought, I was like, this is it, you know, there goes the real estate market. And actually the exact opposite has happened. And do I think another wave of foreclosures is coming like 2008, 2009? I don't. I hate to use such a cliche saying, but this time I truly think it is different. I think the circumstances are different. And I just wanted to break that down for you guys a little bit. So first off, from a legislative standpoint, the Biden administration has been really aggressive in trying to keep people in their homes. Secondly, banks have tools, they have processes, they have procedures to keep people in their homes. And third, owners have real equity now. So let's break each of these down. From a legislative standpoint, like I said, the Biden administration has been very proactive by extending the CARES Act for another 6 months, which basically allowed people to enter the loan forbearance. And for those of you that are not familiar, loan forbearance means essentially you can not make payments while all this mess is figured out. Right now, homeowners have until the end of August 2021 to get their affairs in order, and this is a huge deal. Right now today, there are about 5%, or I think a little less than that, 2.5 million homeowners that are in this forbearance option. So this is great. It's allowed people to stay in their homes. And what's really good is this number is actually coming down, approximately 5% per year. Really sooner than expected as people are getting back to work. It's starting to get warmer. Weather is starting to, feel more normal again. This is great news. But what about everybody else? What about those other 2.5 million people? Are they going to be able to pay? Are they ever going to be able to pay? Can they get caught up? Well, today, unlike 2008, banks actually have loan modification options to help keep people in their homes. Let's be honest, they don't really want to foreclose on people too. It's a big mess, it's an administrative nightmare, and it takes forever. So today, banks have these loan modification processes. It's different than a forbearance. Again, forbearance basically means you're not making payments. Loan modification, banks can either change the interest rate, they could even extend the amortization of the loan. So typically people are out there, they're getting 30-year fixed rate mortgages. Banks can essentially extend that amortization up to 40 years. And who wouldn't do that? I mean, as an investor and a homeowner myself, I would take a 100-year amortization if they would give it to me. And I know this is, a lot of people disagree with that mindset, but to walk you through how I'm thinking about this, I think having that lower payment with a longer amortization gives you ultimate flexibility. Should something happen to your job, should there just be a lean month or you have an unexpected, say, medical expense, you can make that lower payment. And there's nothing to say that you can't pay that 40-year loan off like it's a 15 or 20-year, but why add that added stress, that higher payment, if you don't have to? Another reason why I think this time is different than 2008 is because today, like I said, most people are out there getting 30-year mortgages. Back in 2008, it seemed like ARM mortgages, or for those of you that aren't familiar, adjustable rate mortgages, were all the rage. What that was is you would get, say, a 2-year ARM, so you'd have a 2-year fixed rate, a really low rate mortgage. After the expiration of the 2-year period, in this example, your mortgage rate could essentially float monthly, every couple months, depending on how the mortgage was written up. So what that led to is people had a low interest rate, say 2.5%, then all of a sudden their interest rate was 4.5%. And if you don't realize or haven't looked into how much interest rates can affect payments, just go check out a mortgage calculator online and play with the interest rate. You know, start with a 3% mortgage and change it to 6%. A $1,500 mortgage payment will be significantly affected by that changing of interest rate. And thankfully, adjustable rate mortgages aren't as common today. People are locking in with these low interest rates. So I think that is another reason that this time it is different than 2008. And third, people have true equity in their homes. If you purchased a home, say in the last year, 2 years, 5 years, you're sitting on some true equity. I mean, here in Columbus, we're up like 20% in some areas, and that is a big deal. And it's not just people bidding like crazy on houses, which is happening, but also take a look at the cost of lumber, which is one of the main components in a house. It's up like 300% and it continues to rise. In fact, I'm saying 300% is probably more than that now. So why that is important is what's called the replacement cost of your home. So if the house burnt down, what would it cost to rebuild? Since lumber's up, all the building components are up, the replacement cost is higher. So anytime you could buy an asset that's cheaper than the replacement cost, that is a good deal. This is true equity. So people want to stay in their homes now. What happened again back in 2008, the banks didn't have a loan modification process, so they were forced to foreclose on people, which meant the banks had all these mortgages on their books that they didn't want. And it was essentially a race to the bottom from there. They flooded the market with basically fire sale properties to get their mortgage payment back. Well, today, people aren't upside down on their houses. They have equity, so therefore they're less likely to just walk away from their equity. They'll, sell it at a high price, or they can work with their bank through one of these loan modification procedures. So to me, with all these things and just the tone from the government, I think that the government really is trying to help keep people in their homes, at least, in a residential real estate perspective. I'm not so sure what's going to happen with commercial real estate. I think some people that maybe overbought are going to be in trouble. I don't think they're going to be as protected from the Consumer Finance Protection Agency or the CARES Act. So that's going to be something to pay attention to. But if you're waiting to pick up properties at pennies on the dollar when this big foreclosure wave is going to happen, I just don't think it's going to happen. So in my opinion, should you buy? Absolutely, you should buy. If you're thinking about it, at the very least, I think a home, owning a hard asset like a home, is going to be a great hedge against inflation. Despite what the Fed says, inflation is 100% coming our way. So thanks for watching, guys. Let me know what you thought. Let me know, how you're viewing this situation. I'd love to hear from you. But if you have any questions at all, shoot me an email, shoot me a text, give me a call. My contact information's right down below. But thanks so much for watching and have a great day.